Welcome SIE candidates, compliance considerations. The goal of this video segment is to enhance your understanding of the rules and regulations related to anti-money laundering, AML compliance programs, monetary reports, the U.S. Treasury's Office of Foreign Asset Control, OFAC, record-keeping requirements, customer mail, business continuity plans, privacy requirements, Regulation SP, public communications, telemarketing, suitability requirements, and Know Your Customer (KYC) rules. New account documentation. This video will cover the process of opening customer accounts. For broker-dealers and their registered representatives, RRs, adherence to numerous securities industry requirements begins with collecting and documenting customer information for account opening and maintenance. Effective record-keeping safeguards the interests of customers, firms, and registered representatives. When establishing a new account, specific customer information must be gathered to comply with industry standards. FINRA's Know Your Customer (KYC) rule mandates that firms exercise reasonable diligence to know essential facts about every customer and anyone authorized to act on the customer's behalf. The USA Patriot Act, discussed later in the chapter, imposes further requirements on firms regarding both the verification of potential clients' identities and subsequent monitoring to ensure compliance with anti-money laundering regulations. Customer information is collected on a new account form, not just to satisfy regulatory demands, but also to assist the registered representative and the firm in understanding the customer's investment objectives and addressing their suitability concerns. While each firm's new account form may vary slightly, all firms must gather specific minimum information to meet industry standards. Required information. A registered representative intending to open an account for a customer must secure all required information before entering the initial order in the account. According to FINRA, the following customer information is required: the customer's name and residence. Note that a P.O. box may not be used to open an account, but correspondence can be sent to a P.O. box. The customer's legal age. The name of the registered representative, RR, responsible for the account. If more than one RR is responsible for the account, documentation of each representative's scope of responsibility is required. This provision does not apply to an institutional account. An institutional account is defined as one established for a bank, savings and loan association, insurance company, registered investment company, registered investment advisor, or any entity with total assets of at least $50 million. The signature of the partner, officer, or manager principal approving the account. If a customer is a business or organization rather than an individual, a registered representative, RRR, is required to obtain the names of the individuals authorized to transact business for the account. Prior to the settlement date of the initial transaction, a registered representative must also make a reasonable effort to obtain the following customer information: taxpayer ID number TIN, such as a social security number, occupation, and name and address of the customer's employer. Whether the customer is associated with another member firm. This requirement doesn't apply to either institutional accounts or accounts in which transactions are only conducted in non-recommended investment company shares, mutual funds. Required signatures. Once the customer's information is obtained, a principal of the firm must sign the new account form to indicate approval. Although many broker-dealers have in-house rules requiring customers to sign the new account form, industry rules don't mandate their signatures when opening a cash account. However, for customers seeking to open margin and/or option accounts, their signatures are required. SEC record-keeping requirements. In addition to FINRA's record-keeping requirements for customer accounts, SEC Rule 17A3 requires broker-dealers to maintain the following records for each customer or owner of an account: name, tax ID number, address, telephone number, date of birth, employment status, occupation, and whether the customer is associated with a broker-dealer, annual income and net worth, excluding principal residence, investment objectives. Any information that provides insight into a client's investment experience is critical when determining suitability. However, collecting information regarding a client's educational background is not required. There may be circumstances where customers are unwilling to provide their broker-dealers with certain personal information, for example, their financial background. If an effort is made to collect the information, but the prospective customer refuses, an RR should, as a matter of good practice, document that the effort was made to obtain the data. The documentation could be as simple as writing "refused" in the appropriate space on an account form, with no explanation required. Principals may refuse to approve an account if they believe that the prospective customer has provided the firm with insufficient information to properly assess investment objectives and/or suitability issues. Trusted contact person. When a customer account is opened, a firm must make a reasonable effort to obtain the name of and contact information for a trusted contact person of the customer's choosing. If obtained, the firm is required to disclose to the customer in writing, which may be electronic, that an associated person of the firm is authorized to contact the trusted contact person and disclose information about the customer's account. The purpose of any disclosure is to address possible financial exploitation or to confirm the specifics of the customer's current contact information, health status, or the identity of any legal guardian, executor, trustee, or holder of a power of attorney. Verification and ongoing updating of client information. To ensure that a registered representative, RRR, has accurately characterized a client's profile and investment objective, copies of the account record or documentation of the information gathered must be sent to the customer either within 30 days of the account opening or with the client's next statement. Periodic updates and verification of account information must be sent to the customer at least every 36 months. Change of information. If a customer provides a broker-dealer with updated account record information, the broker-dealer must send a copy of the revised account record to the customer. Member firms are required to send the updated documentation within 30 days after receiving notification of the change, or at the time the next statement is mailed to the customer. Examples of changes that may be made to an account record include changes to name, address, and/or investment objectives. If a request is made to change a client's address, notification must be sent to both the previous address on file and to the registered personnel responsible for the account within 30 days of the change. Know your customer and suitability. A broker-dealer must use reasonable diligence to learn the essential facts regarding every customer. In other words, according to regulators, it's vital to know your customer to provide them with appropriate services. This obligation extends to anyone authorized to act on behalf of a customer, including an investment advisor with the authority to enter orders in a customer's account. Only after a registered representative understands the financial needs of their customers can proper investment recommendations be made. Suitability. Broker-dealers have a suitability obligation to each of their customers. For non-institutional, retail customers, broker-dealers and their registered representatives must have a reasonable basis for recommending a specific transaction or investment strategy, for example, day trading or margin trading. These recommendations must be based on information obtained from customers, which is then used to identify their investment profile. A customer's investment profile includes the following items: age, other investments, financial situation and needs, tax status, investment objectives and experience, investment time, horizon, liquidity needs, risk tolerance, any other information obtained from the customer. Although customers are not obligated to provide all the information listed above, an RR should make an effort to gather as much information as possible to offer the most suitable recommendations. An investment recommendation should be in the customer's, not the RR's, best interest. The simple fact that a customer may agree to a recommendation doesn't relieve a firm of its suitability obligation. Some examples of potential violations of the suitability rule include registered representatives' recommendations of one product over another to generate large commissions, registered representatives making mutual fund recommendations to maximize their commissions rather than establish a portfolio for their customers, registered representatives attempting to increase their commissions by recommending the use of margin, registered representatives recommending a new issue that their firm heavily promotes to keep their jobs. FINRA has established the following three main suitability obligations. 1. The reasonable basis obligation. This requires a member firm and its registered representatives to have a reasonable basis to believe that a recommendation is suitable for at least some investors. If the firm or its registered representatives do not understand a product, it should not be recommended to customers. 2. The customer-specific obligation. This requires a member firm and its registered representatives to have a reasonable basis to believe that a recommendation is suitable for a particular individual based on the customer's investment profile. 3. The quantitative obligation. This requires a member firm and its registered representatives to have a reasonable basis to believe that a series of recommended transactions, even if they are suitable for a customer, are not excessive when considering the customer's investment profile. Age-based suitability concerns. A customer's age is typically one of the factors used to determine if a specific transaction is suitable. For clients who are younger and willing to assume greater risks, listing their investment objective as growth and/or speculation may be suitable. However, age-based suitability determinations are more challenging for income-producing investments since they range from high-risk, non-investment grade securities to very safe instruments, U.S. Treasury securities. In fact, there are certain situations in which a firm may determine that age is irrelevant in assessing suitability. For example, if a customer is seeking liquidity to meet a short-term obligation, age is not a factor when making the investment decision, since liquidity is the overriding concern. If a client is seeking capital preservation, age is again not a factor since the safety of principal is the overriding concern. Institutional suitability. Institutional suitability obligations may vary based on the nature of the institution. Some of these customers are sophisticated and manage billions of dollars, while others may be relatively new to the investment process. For a broker-dealer to determine the extent of its suitability obligations regarding an institutional customer, there are two important guidelines. 1. The firm and the registered representatives servicing the account must have a reasonable basis to believe that the institutional customer can evaluate investment risks independently, both regarding the specific securities and the different investment strategies. 2. The institutional customer must affirmatively state that it is exercising independent judgment in evaluating the recommendations. When dealing with institutional customers, firms are exempt from the customer-specific obligation listed previously. However, the reasonable basis and quantitative obligation standards still apply. Anti-money laundering and the USA Patriot Act, the Bank Secrecy Act, BSA, is the primary U.S. anti-money laundering AML law. However, the BSA has been amended to include certain provisions of the USA Patriot Act to detect, deter, and disrupt terrorist financing networks that use laundered money to fund their operations. In response to the September 11, 2001 attack, President Bush signed the USA Patriot Act into law. The act imposed a number of new regulatory obligations on broker-dealers and focused renewed attention on previously established AML laws. Money laundering generally occurs in three stages. 1. Placement. Money launderers introduce illegal cash into a broker-dealer's business, typically through the purchase of securities. 2. Layering. Launderers carry out transactions across multiple layers to avoid detection or to trigger a reporting requirement. One method of layering, also known as structuring, involves buying multiple blocks of securities using cashier's checks from different institutions, each for amounts under $10,000. Other sophisticated layering techniques include taking opposing positions on the same security, for example, holding both long and short positions, or using various customer accounts for each purchase. 3. Integration. Launderers reintroduce the proceeds from these transactions into the economy, making them seem legitimate. For instance, securities bought with illegally obtained cash are sold, and the proceeds are then deposited into a bank account. Once the funds are spent on goods and services, they have successfully integrated into the legitimate economy. FinCEN's required reports. The Financial Crimes Enforcement Network, FinCEN, part of the U.S. Department of the Treasury, aims to develop and enforce policies and procedures to detect and prevent money laundering. FinCEN primarily achieves these goals through two methods. 1. Requiring financial institutions, for example, broker-dealers, to file specific transaction reports under the Bank Secrecy Act, BSA, and 2. Providing law enforcement with information from these reports to assist in combating money laundering. Broker-dealers must file Bank Secrecy Act currency transaction reports, BCTRs, for all cash transactions exceeding $10,000 executed by a single customer in one business day. Currency encompasses both cash and coins. The reporting requirement is also triggered if a customer makes several smaller transactions in a single day that, when totaled, exceed $10,000. For example, if one morning a customer deposits $6,000 in cash at one branch of her brokerage firm, and later that same day deposits an additional $7,000 in traveler's checks at another branch, the broker-dealer must file a BCTR because the combined total surpasses $10,000 and occurred on the same day. This customer's behavior exemplifies structuring. which occurs when a customer conducts several small transactions that individually fall below the reporting threshold in an attempt to evade reporting requirements. Registered representatives should remain vigilant for clients who execute multiple transactions just below the $10,000 reporting level or who deposit sequentially numbered instruments. Broker-dealers may also need to file suspicious activity reports, SRs. Before the enactment of the USA Patriot Act, only broker-dealers that were subsidiaries of bank holding companies were obligated to file SRs. Now, a firm must file an SR whenever a transaction or group of transactions equals or exceeds $5,000, and the firm suspects any of the following activities. The client is violating federal criminal laws. The transaction involves funds linked to illegal activity. The transaction is structured to evade reporting requirements. The transaction appears to have no legitimate business purpose, and the broker-dealer cannot find a reasonable explanation. After reviewing all available facts and circumstances, the filing of an SR is confidential, as is the information within the report. Under no circumstances may a registered representative inform a subject that an SR has been filed. Instead, disclosure is permitted only to federal law enforcement or securities regulators. To avoid overwhelming you with long videos, we'll keep it brief and easy to digest. Join us for a follow-up video where we will continue the discussion from this one. As always, please like this video so others can benefit as well. If you are a new viewer, we invite you to join our family with a free subscription.